Neil Lay from Invesco Quantitative Strategies. Welcome to the Equities and Growth Symposium.
Thank you, Drew. Great to be here.
One upfront question for you. Can you explain factor-based investing for us?
Yes, sure. So factor investing is a way of getting a better share of the equity risk premium, because the equity market earns a premium mainly driven by the returns of companies that grow. It's a growth asset class, and that have the quality of management and of balance sheet and of revenue to actually execute on their growth plans, and at the price, at a reasonable price that can give you that return. So those factors drive the equity risk premium. Factor investing tilts towards those factors that drive the equity markets to get you better access to the overall premium of the market.
And what are those four important factors?
Yes, well, the most important for generating return are growth, quality and value. And that's why you'll see almost all investment managers have those at the cornerstone of their investment processes. So when you tilt to those as factors, in the quant land, growth is most easily picked up through momentum. That's kind of contemporaneous growth as earnings are expanding and prices are moving. So that's the growth component. And then quality and value factors as well. They're the three that get you the most access of increasing your share of the equity risk premium. And volatility would be the next most important one after that, which gives defence and downside protection as well.
And could you explain the difference between earnings and price momentum?
Sure. So earnings is looking at the underlying expansion of the company operations and how it's coming through to the top line. And so that gives you a view on how the company is actually progressing contemporaneously, and it gets you in on companies as their success is coming through, whereas price momentum is more a kind of market sentiment reinforcement, which can and often does correspond with the earnings expansion, but can also run ahead. In the cases of companies that have a growth a little further out, it can be a strong signal that that growth is coming through with the market confidence.
And the value factor is having a bit of a renaissance at the moment. Can you explain what the inputs are into that in a little bit more detail?
Yes, well, value factor, the valuation, it's best to have a combination of a few measures, because no single measure encompasses the whole of a value of a company. So normally you would have a range of earnings and cash flow and even book measures depending on the industry and the country you're in. Then the combining those factors gives you a handle on relative valuation if you use it in a very strongly relative sense. So an important part of a value factor is comparing like with companies. So those two aspects, and that's the way you can actually draw out some returns from value, even when the economic environment isn't best suited to value investing.
And how important is the correlation between the factors?
It's really beneficial in multi-factor quantitative processes. So the value factor, to take as an example, isn't the strongest factor, particularly in Australia, for generating returns just as a quantitative style. Momentum actually is far more successful, but momentum gains a lot by having value added into it. It's because it acts as a guardrail on the excesses of the momentum factor, chasing sentiment without fundamental underpinnings. And so you get much more value from your value factor, if you like, when you add it in with other factors. So there's that synergy, as well as just factors playing their role in different parts of the cycle to give you diversification through time.
Excellent. Thank you, Neil.
Thank you, Drew.